Welcome to Swimming with Alligators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernst Young. You ready? Let's dive in.
So a big welcome to our guest today, Lisa Cawley, Managing Director of Screendoor, an investment platform with a highly regarded GP advisory program that supports new managers raising early institutional venture funds and building enduring firms. Screendoor's role as an LP of GPs is a connection between new managers and institutional investment community. Prior to Screendoor, Lisa has spent over a decade working on private market portfolios across investing and operations. Today, Lisa is going to share with us her favorite stories and lessons learned investing in venture capital. We're thrilled to have you today, Lisa. Thanks for joining us.
Thank you for having me. It's a long time coming.
So we first love to start just kind of setting the table. Could you share with us your LP career journey?
Yeah, so I like to tell people that it's actually relative to others and relative to most, it's a little bit backwards. So I actually started my career at EY, and I think for anyone who doesn't know what they want to do in their career, it's like the best playground to figure that out. Figure out exactly what interests you, but just most importantly, what doesn't interest you. So I had a whole bunch of clients, healthcare, insurance, CPG, and really where I spent the bulk of my time was in two areas. The first is I was auditing venture funds and their management companies, which was like my foray. That's how I learned venture. It's how I learned to tick and tie, how all the statements work together, the backbone of basically when you're running a fund, what actually needs to happen behind the scenes. And then the other piece of it that I think actually still informs how I think about ventures, that I had a public company client. I was on McCormick Spices. So if you guys know the little red cap, although the gourmet comes in different colors, but public company. So there was heavy SEC reporting, very compliance driven. It was just a phenomenal experience to be able to understand like how the SEC works, how you balance, reporting, financial integrity, all of the ins and outs of like what regulates the financial industry. And obviously that's a little bit different and ever evolving in the private market space. But I think it really gave me an appreciation for just like the backbone of what needs to be true on paper before you can even layer in the human component. And obviously in venture, the human component is so much more magnified than arguably in other asset classes. So loved that experience. I'm still best friends with so many of the folks there today. And also that's how I met my husband, fact. So okay. Great all around. But then from there, I had an opportunity to go work on a portfolio where basically I was involved in all aspects of building this venture portfolio. And so within the private markets, that was everything from funding new firms, capital activity planning, of course, thinking through like the operations of how you take what I had seen in venture funds and their management companies and applying that into LP world. Building up the, whether it was the data and analytics and how we tracked things, but then also, of course, the due diligence process and everything that classically goes into making an investment. So I was really fortunate. I got to observe everything across VC from small funds, big funds, sector specific, generalist, stage specialties, every geography you could probably imagine. And also, naturally, every firm sophistication that you could imagine. So I did that for about 8 years and was a wonderful experience.
Before we get into the Screendoor, Lisa, I'm curious, you can throw a rock in the valley and hit a VC who's talking on a mic on a podcast, talking about what's changed in their industry. But rarely do we have an opportunity to talk to someone who's an experienced allocator like yourself. What's changed from your side of the table? In the years, and what are kind of the challenges that someone who's growing their career as an allocator, what are they facing today?
I think what has changed is just the sheer number of choices, both for LPs and for GPs, and I think arguably too for founders. I think it's a good thing for founders to have choices, particularly in who they take capital from. It's why I think that new funds coming to market is a good thing and will always be a good thing. And yes, that will ebb and flow over time in terms of the volume. But I think that no matter what's going on in the broader macro, interest rates, politics, what's going on in the public markets, like all of those things, yes, they impact and influence venture at the highest levels. And there are ripple effects there that are very, very real. But when you look within venture, I think that if someone wants to do something innovative, they're going to do that and run into a wall to do that, right? Like it doesn't matter. They're not going to sit back and be like, I'm going to wait until interest rates are better and then I'm going to start my business or then I'm
Yeah.
going to start my fund. I see that a lot too with managers. They're trying to time their fundraise based on their perception of re-ups. And I always like to give the example that if you speak to two LPs hypothetically, you could have one LP who has 75% of their portfolio that will re-up in the next vintage or have a re-up to consider in the next vintage. You could talk to that next LP and they could just be coming out of a vintage where that was true, meaning that that won't be the case. So much of, I think, again, maybe perhaps this isn't what's changed, but what's still the same is venture will always be about doing the hard thing, no matter what all of the other variables are. I think what's changed is that there's just so much more to parse through and so many more choices that it all goes back to the relationships helping you do that.
Yeah, one of our predictions was that GPs in market are going to be kicking themselves that they weren't actually fundraising in 2023 when fewer people were knocking on your door. So, what is Screendoor? What is this door that they are knocking on?
Well, we hope it's a welcoming door. I think that's first and foremost. So, Screendoor exists. I think is the lead in shared. Screendoor exists to fund new managers and help them get their first institutional funds raised. So, to be clear, we're a fund of funds. We invest and build a portfolio ourselves. So we have a very high bar that we underwrite to. It's not a program where we kind of work with a batch and then get a new batch. It is a portfolio that we're running. And I think our main goal and thesis is that, again, it comes back to this idea of the new. We always want people to be investing in the new in venture, perhaps not as the only thing they're investing in, but as a really important component of their portfolio and of looking into the future, right? Like venture is one of the most longest duration asset classes there can be. And so you have to be thinking 5, 10, 15 years ahead of time when you're making decisions. It's very hard to be quite, myopic and week to week when you're investing in venture, although it's natural. And I think we're really looking to back new managers who their lived experiences are what differentiates them. So everybody will go through experiences in life. And to me, that's what shapes your identity. And that's what I find so fascinating is people's stories, like what you've been through, what gives you an ability to attract a founder, right? Because they're going to lean into what's different about you relative to maybe another incumbent, right? And so we're looking for managers that are not sitting there saying, I'm just going to follow on whatever this incumbent is doing. I think a lot of those funds are, while they play a really important role in the ecosystem and have phenomenal investors, they can be very consensus driven at times. And I think there's a lot of white space for people who have this differentiated view, and it's matched with a fund size that's appropriate. We're investing in managers who we think don't actually need our help to succeed, but who we hope that by our participation and our point of view that we can provide compared to other LPs and other participants in their fund will actually give them access to more information, more perspectives, more ways to make better decisions as they build their own firm. And that will be the reason that they hopefully are successful in the long run. So our participation, we hope, can increase and hopefully speed up time for their likelihood of success. Of course, all of that is hypothetical, but that's our goal, is to really get new managers in business and help them build their brands for the long run.
So cool. What are the GP advisory services?
Yeah, so this is really the backbone, I think, of when I think about Screendoor. I think about it as being a firm that is for firm builders by firm builders. So the GP advisors, you can see them on our website. We just actually announced we have 4 new wonderful, wonderful GPs that have agreed to join us. So 14 total. But Screendoor was really started with the idea from these GP advisors that not only do they have just insane reach from networks, right? And they all have raised their first fund themselves. But over time, they've amassed such knowledge and such experience that when you have a new GP who comes across these things in their day to day, somebody who can give you that perspective and say, hey, I've been through this. Here's a couple things you may want to consider when you're making, XYZ decisions. So that's in theory what the GP advisors are. How that actually works in practice is that they help augment our diligence process. So we love having new managers have the opportunity to meet with a couple of these GP advisors because we find that an LP to GP conversation is just fundamentally different than a GP to GP conversation. I think it's probably one of the most valuable points when people do engage with us in diligence, regardless of the outcome, to have that opportunity. They probably can ask, again, questions that are on their mind and get feedback. It really is a feedback conversation, less of an
Mm.
interview or interrogation feel. And then I think the real game changer, I would encourage you and anyone to really ask our portfolio this question. But I think the real game changer for most has proven to be our advisory part. So we pair every manager in our portfolio with two of our GP advisors. And we try to do so kind of through a different mix of considerations. But ultimately, the goal there is that you have somebody that, again, as you go throughout the many, many, many things that you'll have to tackle when you're building your firm business, you can lean on them for one point of view, right? They're not there for the answer. They're just there to give you, you don't know what you don't know, and they try to help you maybe see around corners. So an example of that might be a really common one that we hear is around people developing their teams over the course of building their firms. So for example, if you have, whether it's a solo GP or perhaps a two-person partnership, and they over time want to plan to bring a partner on, that's a really important decision, not only for the benefit of the existing partnership, not only for the benefit of the whole platform. You also have to think about economics, about messaging that to your LPs. How do you pressure test that relationship? How do you find that person? How do you vet that person? How long of a period of time should that be? Like, these are super basic questions. There's so much more in the nitty gritty there. But when you have access to folks who arguably have all sorts of different partnerships that can give you perspective of, well, we did this. Obviously, everybody knows, for example, the homebrew model that is perhaps quite different than Charles Hudson at Precursor, or when you think about Kirsten Green at Forerunner and how all of these different GPs have built their team. They can really lend support and different perspectives so that if you're the new manager saying, all right, I need to go from fund one to fund two, how do I navigate this? Should it actually be over a fund cycle? Should it be over 3 fund cycles, right? There's really no one size fits all answer. That's what we always like to tell folks. And so they're there to help you try on those different sizes and figure out which one is probably the best for your path and your trajectory of your firm.
That's awesome. Sounds like real kind of like mentorship and apprenticeship that, we talk about in the industry, but rarely see a lot of times. And that specific example about how you expand your team, really, I'm sure shows light on how you're thinking about where gaps you have and how that eventually gets you to kind of a steady state of an institutional firm. Um, and where you think it needs, what type of profile needs to fit that. So I know that's really cool. How was your approach as Screendoor to your portfolio construction? And kind of context is I really love having fund to funds on because they have to deal with this similar approach too, of like, how do they present themselves differently? How do they build their own strategy? So what's kind of the approach from Screendoor's perspective?
Yeah, I think you hit on it too, that in addition to kind of the for firm builders, by firm builders, by way of being a fund to fund, like, we have maximum empathy, even more so because we have lots of people who have also had to raise funds over time. And I think, again, it's an overarching theme in how I think about my day to day. But again, it goes back to the people, right? Everything comes back to the people. And so for our portfolio construction, quantitatively, we want to be a minimum 10% of a fund. And our goal is to make sure it moves the needle for us, but that it also moves the needle for that GP as they're trying to get their first fund raised. And here's the people part, is that we care deeply about the other partners that are around the table. It's why we love working with actually so many of the folks that have already been guests on your podcast and probably will be in future episodes. So what we try to do is we are happy to be first close. Depending on when we meet someone, we may fall after that, but we don't necessarily make our decision based on, I think everybody knows, like the old LP thing, what's everybody else doing? And I always like to remind managers when they're thinking about that in their context, that every LP is so different. So they're not making decisions, or shouldn't be making decisions, based on what other LPs are doing, because each one of their portfolio asset allocations, whether you're a family office, an endowment, a foundation, a health system, they're all quite different in their goals. And even you could have two family offices side by side and their portfolio construction is quite different. So we're not making a decision based on who else is coming into the close. So we're happy to do that. And then once we are in that close, like we are more than happy and spend a lot of our time actually helping round out that raise and trying to help with introductions, trying to help share our perspective, our references with other LPs who are also committing to fund ones. And I think it's really important that there's a healthy group of collaborators around the table there. Because again, we think it's really important for managers to have a lot of access to different avenues of advice. And so that's what we overall try to do.
When it comes to that top of funnel and today, just like your emerging managers coming up, what challenges do you feel like they're facing that's different, even in 2024 in comparison to 2023?
Yeah, I think some of them are the same, and that it's always going to be the classic catch 22 of you need a track record to raise the fund, but you need to close on some capital in order to build that track record that's attributable to that brand. And I think for the LPs out there, it's really important to remember that you can't underwrite a fund one the way that you would look at a fund three, a fund five, a fund 10. And so there are always going to be frameworks where you should, of course, check those boxes in diligence. And I don't simply mean check a box. I mean, like, do that component of work. But you need to analyze things differently. And you need to look at how you think about team, how you think about track record, how you think about references, all quite differently. And I think that is a challenge for managers because I think so often they start to have really, really interesting conversations with LPs who like their thesis, who like their team, who have some kind of warm introduction that has kind of serves almost as like a mini offshoot reference. But at the end of the day, what starts to break down is somebody saying, well, we need to see more. And I've said that before. Like, I will probably continue to say that. And it all depends. But everybody's definition of more is quite different. And so when you're taking a fund one and you're underwriting it, I think you need to look at that track record differently. I think about it, of course, there's one part that's always going to be the how do I, look at the company attribution, or even if you can't, there's some places where people have investment experience, but you can't take your track record with you, or you don't have an attributable, it's not as simple as just spitting it out on a spreadsheet.
Yeah.
But the other thing I think about a lot is somebody's investment of time, because time is the only resource that we all have the same of that we will never get back. And so to me, it's arguably the most valuable resource because capital will come and go, obviously sometimes easier than others. But when you look at how somebody spent their time, that to me is really, really compelling. And how that translates to diligence in fund one is when you think about somebody who had operating roles. What kinds of companies were those? What did they gain from those experiences? How long were they there? How did they continue those relationships after they left? How does that feed into their strategy now? And so even though that's not, hey, they wrote, X number of checks at X dollars and that maps to their strategy, that's still a really important consideration because so often I think LPs will end up waiting for that track record where they can draw the dotted line of like, yes, this track record happened under this firm, so our IC can be comfortable with it. That's all well and good. And those committees are, again, doing good work. But when you look at a fund one, you need to be willing to like draw one additional line to consider all those other points.
How people have spent their time. That is a very helpful tip, I think, for other allocators who have maybe been unsure about how to think about these fund ones. For our emerging managers listening, what are some of the things you look for in a Screendoor GP?
Yeah, I think one of the most important things and where we spend a lot of time is just the concept of GP market fit. And so we look for folks that there's something in their background that suggests that they have a consistent and outsized advantage in their ability to, as we all know it, source, pick, win, and support managers. But I think that sourcing point when you're a fund one is really, really important. You want to demonstrate that you can be, I like to call it, be a founder magnet. We say that all the time on our team. Is this person a founder magnet? Are they attracting the best? Are they swimming in the right circles? Super important. I think a lot of times we see folks where what I hear from them, some say it bluntly, some it's kind of the undertone, but they'll say like, I always wanted to be an investor. And I think the best investors are folks that Like they didn't know that they wanted to be an investor. The investor part was just like the solution, right? That was the end of the sentence. That was a byproduct. That wasn't the goal. And so we look for folks that they can attract the best founders because they can provide some sort of very specific support to that founder. I like to say too that when you're looking, and we're investing, just for clarity's sake, in pre-seed and seed, a little bit of A, so mostly early stage, US focused first institutional funds. And by way of our fund sizes being small, right, like under 100 million is our target zone. On average, call it between 10 and 60 is usually the sweet spot. Though there's argument, of course, to be made otherwise. But when I think about what founders are doing, right, like they should be looking, they're so resource constrained at the earliest days. They should look at their cap table and say, yeah, I go to this person for this thing. I go to this investor for this, right? You don't have to be all things to all people. And I think the two common, we can dive into some of this, but the two common things I always see is folks trying to be all things to all people. They're like, I help with these 25 things. And it's like you're a jack of all trades, master of none. And that can be good if you have an army of people to support those things. But my favorite conversations are the ones where the manager is like, I help with, go-to-market support or hiring, right? Like that's my sweet spot. I do that. And then also I get out of the way. I think that's a really, really, really important thing for a new manager to be able to just understand. It's hard to demonstrate that on paper, but at least in their own relationships, it's important to know when to lean in, but also when to, let the founder do what they do best.
What other kind of like light red flags do you see from a lot of first time fund managers?
Yeah, light red. I like that. Dark red.
Or dark red, or beet red.
50 shades of red. So some of the things that I think can trip new managers up is, of course, portfolio construction. So on my team, we have a whole bunch of different views around portfolio construction, which I think helps us make really strong decisions. So for example, one of my partners, Jamie Rhodes, she has a very specific focus around her portfolio construction beliefs and philosophy. That's just one way that we think about things at Screendoor. And so when we're looking at someone's portfolio construction, some common things that just don't map always, things like the dilution doesn't make sense. It's overly optimistic, especially at pre-seed, assuming percentages that don't map. Exit projections that don't map industry data or that individual's own investment history, right? So if you have a portfolio of 25, assuming that 5 to 7 of them will be IPO candidates. Highly unlikely, although, again, I'm hoping that we're in those funds, of course. So we're underwriting that. And then I think a really big one is this concept of just a lack of differentiation. And I know it's a frustrating point for managers, and I get that, but maybe I can peel back the onion on that a little bit. So for me, a lack of differentiation always starts when we can't see how this kind of stands above the pile, right? Like we're reviewing someone's deck, we're hearing their story, and it's really, really surface level and really, it lacks a lot of detail. And so I like to give the example of like, when you go in and you pull the template from whatever your word processor product is, and it's like, I'm going to make a resume, and it comes with the pre-template. I always like to joke with managers that I think if you're going in and you pull a PowerPoint, right, and you have the words differentiated, unparalleled access, unique networks, like I know managers that have this riddled throughout their deck, and that's great. And 10 years ago, 15 years ago, that might have been great. That might have stood out. But today, what you should be doing is thinking of that as your template. And you should go in and say, okay, differentiated access. Let me take those words out and put in what I actually mean by that and how I actually have differentiated access. And being more specific there, and when you can quantify, right? It's the concept of value add. Like, how did you add value? I add lots of value with my networks. You made 25 customer introductions. You helped get 10 pilots set up. You made 50 recruiting, for team member or future employee introductions. Like those are all valuable pieces of data, especially for fund ones that might be lighter on a traditional track record, that can be really, really helpful for an LP so that they can go through and see, how is this person actually operating? And then when you think about an LP's diligence process, it would be my hope, of course, that all of that would then map to your referencing conversations, right? When you talk to founders, it all makes sense of how impactful that was for them in the earliest days. So I wouldn't say it's a red flag. I would just say it's like there's no flag there that flags it to us that it should stand out and that that's someone that we should spend more time with. So I always encourage people to kind of rip those words out and be as specific as you can. And I think one that's maybe not talked about as frequently that is a red flag is around just legal and operational items. So it's probably no surprise, just given my background, that that's something that I'm always thinking deeply about. And for Screendoor, our goal is to get you set up with an institutional quality LPA to make your close as easy as possible for other institutional quality LPs. And so I think sometimes we see just like wacky, goofy terms, things that don't really map to market or that aren't mapping to that GP's experience. And those are all things where we want to help you through that, right? Like we want you to know the terms in your LPA. I think it's really important that the GP like owns that and knows what's in there. It's not I don't know, my lawyers put that in there, I'll figure it out later. Like this is a 10+ year document that you're agreeing to. You should know those terms. And so I try to always be a hopefully friendly person in that conversation where I can explain to you, here's the term as we read it here. Here's how we feel about that at Screendoor. Here's how other LPs might react to that and the different kind of moving players, right? Endowments, foundations, family offices, check sizes might play into that. And here's kind of how all of that shakes out and what we think, how we think that will feel market wise. So I think those are some areas that you can go through, right? Like you get all the way to the end of you've made it through diligence and heavy referencing. And it's like that last mile of legal can sometimes be the hardest part. It's what, every manager wants to rush through because you just want to get back to the business of investing. But it's so important because, again, it is part of the backbone there.
Now we're going to take a quick break to speak with our sponsor.
On the show today, we have industry expert and sponsor Nick Rankin, managing partner at Camber Road, the most cost-effective and flexible leasing company for venture-backed businesses. Thank you so much, Nick, for partnering on this show.
Thanks for having me. I appreciate it. I'm excited.
Thank you. You were overseeing global securities lending and equity funding ops at Jefferies when you made the move to start your own business, Camber Road. What were you seeing? I think it was 2018,
yep.
That made you want to open your own shop.
So my three partners worked together at an equipment financing company, an equipment leasing company. And so they had been in the business for a long time. I was kind of the outlier who hadn't been. And I spent a lot of time with them and understood the business. And, they were ready to leave and start their own company. And once I understood it, like I thought it was a really interesting opportunity. And so kind of the combination of those things led me to be like, let's go do it.
Yeah. Well, that's very helpful to know that you were sort of the one coming from the outside. For those of us who aren't as familiar with debt financing in general as it applies to venture, could you sort of address what maybe limited partners or venture capitalists listening might get wrong about the work you do?
Sure. So I think it's like my honest answer is I think it's probably less about like what they get wrong and more they just aren't aware that it exists.
Yeah.
And so if you think about kind of the venture-backed ecosystem, I feel like both kind of founders and entrepreneurs and the investors, they understand equity, right? I mean, that's kind of like table stakes. I think most founders and investors understand venture debt. Many haven't heard of or haven't experienced equipment financing. And so our business model is very simple. We're a leasing company. So at the end of the day, we're buying equipment, and equipment can be big, heavy machinery, or it can be laptops, tablets. I think a good rule of thumb is think of anything you can put a serial number on it. We're buying it from the vendor and we're leasing it to the company. So maybe kind of like the next level down of the question that you asked of what's like misunderstood about it is now we're talking about a lease versus a loan. Mm-hmm. And there are differences there, right? Like I think the main difference is we don't have a lien on anything other than the equipment, right?
Yeah.
We own the equipment, our customers rent it from us. With a loan structure, usually somebody's going to have a senior position, and they've got recourse to the entire company.
Totally.
So there are differences between lease and loan, but I think like higher level, like it's less about people misunderstand it and more about they don't even know it's an option.
Totally. Yeah. We don't like getting leveled. I hear that.
Yeah.
Is there anything we can learn from continuing on this kind of history lesson from this 2020, 2022 era where debt was plentiful across the board, not just equipment financing, that operators listening, can do to de-risk themselves today? It's like, how should we think about it now? Any lessons learned?
Yeah. So I think the high level thing to think about and remember is markets are cyclical. And, that was certainly a cycle of, easier, if not the easiest money we've ever seen. And I think when you combine that with the fact that one of the most important things, if not the most important thing for a founder, is don't run out of money.
Yes.
And so it's really hard when like money's super easy to keep that in mind.
Yeah.
And I think the other thing to think about or to keep in mind is building relationships is tough and it takes a long time. And so having multiple financing partners is important. It can often be easier to get them when times are easy. But I think the thing I worry about or I think about a lot is like we all have such a short-term memory. And, I don't know if interest rates are ever going to get to zero again, but I think money will get easier again.
Yeah.
And people will tend to forget about what happened when the easy money went away. And so I think the biggest takeaway or one of the biggest takeaways for me, and I think potentially for your listeners for that period of time is the market has cycles. Things can change. They can change quick. Get multiple financing partners. And what we talk about a lot with the companies we work with is, we're an all-weather company, right? When times are good and times are bad, we can do a lot to help extend runway, but it's harder to come in like when times are really tough, and start to develop that relationship. So I think that would be one of my key takeaways from that era.
Yeah. A great reminder. I do think that's a big point for anybody who ends up being a career investor. Maybe your founders are going at this the first time.
Totally.
And you want to be able to give them that context of what's the best use of their time and energy, fundraising, bringing their funding partners around the table, even talking about acquisitions at the same time.
For sure.
It's like every time you're doing a fundraising raise, also worth having 2 or 3 conversations with potential acquirers, because those are the same idea. It's like you don't want to be knocking on their door when things are tough.
Exactly. No, I would think, like in an acquisition phase, like, having spent months or years building relationships with potential acquirers is, it's a similar theme, I think. And that takes time, and it's harder to remember to do that when the times are so good.
Yeah. And any other final thoughts that, as long as you've got this audience?
I think my final thought would be, for anybody who's listening, if they know people in the ecosystem and they're talking to friends, they're talking to colleagues, and somebody says, I'm buying stuff, right? Or I got to buy stuff to grow my company. I got to buy stuff to grow my business. It could be, again, big manufacturing equipment, or it could be to build out your office. Just think back to this podcast and be like, who's that guy Alexa was talking to? Where they're basically like, we've got a creative way to finance stuff.
Yeah.
Have them call us, have them reach out. I think we can be very helpful. We can, at the end of the day, like we're non-dilutive capital looking to help extend runway. So that would probably be my final thought. If I could like plant one seed in listeners' heads, that would be it.
This is a true partner in the ecosystem. This is a win-win. Yeah, I hear you. Well, thank you so much, Nick.
My pleasure, Alexa. Thanks for having me.
Thank you for being on the show. If any of you listening have portfolio companies interested in buying stuff, whether that's heavy equipment or laptops, you can reach out to Camber Road's managing partner, Steve Aronson, ARONSON at camberroad.com for equipment financing. And now back to our LP interview.
Lisa, one question that I always like to ask allocators is, what's your favorite questions to ask a GP to get to know them better?
Yeah.
And why?
Yeah. I love this. Yes. Why are you doing this?
Yeah.
Because it's so open-ended. And I think that tells me a lot that I can learn about that person, right? What motivates them. And I think for us, right, it goes back to Screendoor's thesis, right? Like we're investing in the new, we're investing in people that are bringing their different perspectives and backgrounds and folding that into the DNA of their firm. And so often, like some of the most interesting answers come with that backbone. So why are you doing this? Why does the world need another venture firm? And why is it you that they need? And I think all of those questions together give us really, really good insight where it gives the GP an opportunity to explain how they plan to stand out in market and candidly just work with all the other players in market. I think that's also really important, is that self-awareness. But we love to learn just those backstories and why we think that this is someone that like they're going to do this for a long time, right? We're looking at somebody who they're saying, hey, I see this void in the ecosystem and I think that founders need me, and here's how I can deliver potentially outsized returns to LPs and how I'm going to build that into a firm.
Do you think fund managers undershare or overly share their personal backgrounds and how that shapes their perspective?
I think it depends. Super hard question to generalize. I think that you will have some LPs who won't be interested in that, and they'll be interested in the numbers and how those look on paper. I would say that those LPs are probably best suited to be underwriting funds that are later in their firm history, not necessarily later stage, but just later in their firm development. But I think that folks that are looking to invest in emerging managers absolutely want to hear that. I know I do. I think it's really hard for me when someone isn't sharing because then we kind of find that it goes back to that lack of differentiation, right? Like we don't get to hear that. So we like to spend a lot of time later, or I guess I should say throughout our diligence, where we can get to know that person. And I always say err on the side of telling somebody your story, because you never know what will resonate. But if you don't share it, no one would ever have a way of knowing.
Yeah. That's an interesting distinction, that if you're raising for fund 4 or 5, the team slide is probably just one slide. But if you're at the beginning of this journey, your story is the story.
Yeah. And we love to hear it, right? And I think that's why, again, we started it with it being about the people. And I think on every question, you could argue that there's some theme or underlying driver, right? That it always comes back to that story. And I think, whether it's, finding that somebody grew up in the same place as you, or shared sports team, or shared family dynamic, right? Like these are all things that we think about, like socioeconomic upbringing, being an immigrant, like all of those components of somebody's story shape how they think about life and how they might think about, if you're a manager, that investment, and being able to relate that to an LP who might also potentially have something, when they're thinking about a manager, that can come into play as well.
And how does this work for re-ups? Are you looking for people that you'll continue to participate fund after fund?
Yeah. So when it comes to re-ups, we re-underwrite everything. And I think that that's probably an important distinction from a lot of other, longstanding LPs, where their model is intentionally so to invest in one fund, but they're really doing it with an eye towards multiple funds. And I think a lot of times too, for us, that comes down to, we've always been focused on new firm builders and first institutional funds. We have considered re-ups and will continue to consider re-ups. And when we think about that, there are things that you can underwrite that you can look at from a fund one or fund two. That's the most common question I get asked is like, gosh, well, what do you actually look at then? Can there actually be anything? And again, the answer is if you're just looking at face value on paper, you could argue that there perhaps is not much. You could get lucky and there could be a lot, or perhaps unlucky and there could be a lot, depending on the type of detail that's there and the direction of the portfolio. But there are other more nuanced things that we consider in our underwriting when it has to do with the team evolution, how those underlying businesses are performing. We look at a pretty deep look at whether they're actually meant to be venture backable companies, whether there's been strategy drift in the portfolio in a very thoughtful way or in a way that actually demonstrates that your brand hasn't resonated as well. So those are all things that when we're working through our re-up process, we put everybody through just an equally rigorous process, but with nuance to know that, it's a different type of data set that you're evaluating. And that's a really important part of our internal work as well.
Lisa, it seems like that we're in a moment, I'm going to spin out moment in the venture space. And I've been so really inspired by a lot of friends who have left places I never thought that they would leave to spin out. So how do you see that evolving in the next decade in venture, and how is Screendoor kind of preparing for it?
Yeah, I think overall, when I think about the industry, I've always thought of the industry over the past, when I look back on the time that I learned it, decade or so, there's really been this separation of being on one end of the spectrum, venture beta, right? So you have large multi-stage platforms with lots of different resources at their fingertips with much larger fund sizes. To me, that's venture beta, and that plays an important part in a multi-asset class portfolio for an LP. But then there's also the venture alpha side of the equation. And so I think the biggest challenge is always when LPs aren't looking to deploy on a consistent vintage year basis. That is what really actually hurts them. And I think there's always this like misperceived look of like, well, my venture returns were bad in this one quarter. And if you look at things only in a singular myopic quarter, that is not how you can look at venture per se. And so I think both venture beta and venture alpha play a really important role in a portfolio. If you drill down and you look at what your question is around maybe folks that are individual investors moving from venture beta to venture alpha, I think that that's where some of the specialization comes into play. So again, somebody that has had an institutional investment experience, they've been at a large firm, they have seen what a quality and rigorous diligence process is. They've seen what it means to be a fiduciary, right? Because you're managing capital on behalf of somebody else. And they've developed their thesis and their relationships and networks. And I think that that can be a real advantage. I think the challenge is that sometimes when you think about the profile, they may not have had experience and expertise spending time on firm building, right? So they've been very focused on deals, investing, and their investment strategy. And I would say that's a good thing, right? Like you can't teach somebody, you don't want your fund one manager to be learning that after you've committed. That always has to be true. That has to be exceptional before you even start. But what can be learned if they're open to it and have the right orientation is all of those fund admin things. I think most investors, when they go from being an investor to fund manager, which is something really important, like that's a part of our diligence when we look at fund ones. When they go from being an investor to a fund manager, I think they're often surprised that on any given day, a large percentage of your time is actually not spent on the investing component. It's spent on the fund component, raising capital, communicating with your LPs, dealing with your fund admin, your lawyers, all of those different things. There's probably a huge long list, tax, audit, all of which are extremely important and you can't put on the back burner. But I think that's the one challenge that a lot of the new managers will have when they come out. We have folks that have balanced those things over time. We have a team of LPs ourselves too, that we can lean in on a lot of those things. That's probably where our team spends a lot of time on any given week as well, as helping managers through that, helping them think through their LPAC, how they can get the most bang for your buck per se, when you think about how you want those folks around the table. I think that an LPAC candidly is like one of the most underutilized tools that a new manager could have if you structure it properly. So that's how I view kind of the difference. I think it's those firm builders are moving from venture beta to venture alpha. And I think founders are the ones that are going to benefit the most.
And if you are interested in getting access to the alpha layer, why are LPs interested in working with Screendoor?
Yeah, so I think LPs have a couple challenges depending on their size and shape that they're all working with. And I think the first is just their team bandwidth. If you're only spending a fraction of your time on venture and a fraction of that time on what we'll call this venture alpha concept, I think that means you're probably going to have a much smaller pool to pick from. And you're also going to be going back to that timing. You're going to miss that constant deployment into some of these new managers over time. So I think team bandwidth is number one. That's somewhat related to what I believe is number two, which is just limited access and network. And so if you're not fully focused on venture, if you're not kind of ear to the ground on who some of the new managers, when they first come to market and first start forming their funds are, that's a really, really great way to have a partner to help you through that, right? To help you build those introductions with folks. And we do that with our LPs quite frequently, where they, of course, will have their exposure through us, but then over time, they'll have an opportunity to get to know these managers well in advance of when they would be a fit for their portfolios directly. And so there are a lot of large allocators that they need to, write a certain check size that candidly is the size of a lot of our managers' funds, right? When you think about and call it that $10 to $100 million range, some LPs, like, that is their minimum check size. And so that structurally limits them from being able to access this area. I think the other element too is just the network side of it. So we have across the 14 GP advisors, obviously they all have so many new managers coming to them looking for advice. And so now they can work with Screendoor so that we can spend time with those managers and help them get into business. And our LP team, so myself and my two partners, who all come from different LP backgrounds, different types of allocators, but have all been like very squarely swimming in the emerging manager ecosystem and spending time underwriting a fund one and knowing the difference of how to underwrite a fund one versus a fund 5, 6, 10, 15, I think is so important. And so having those two things combined together is pretty unique. And lastly, I think if you're only going to be spending a fraction of your time, then that means you're only potentially able to commit and make one sector bet or make one geographic bet when you think about that direct fund commitment for those larger allocators, or even for smaller family offices that just they've never committed to venture before and they're looking to build that part of their book. And so when you're forced to only make one or two fund commitments in your portfolio, you end up increasing your risk in venture because now you're also dependent on that very sector specific risk that you've made. Whereas a fund of funds approach, this is classic academic fund of funds. Thank you to my CFA Charterholder knowledge. Is you can diversify away some of that risk in a fund of funds model, so you can build exposure, get to know and build your networks, and then double down as managers again start to prove themselves.
Well, thank you so much, Lisa, for being on Swimming with Allocators. Is there anything we didn't get to cover that would be fun to address?
I think that if you are a younger LP, that the best thing you can do is start connecting with other younger LPs. I think for me, that is one of the ways that I was able to tap in and find my sense of community. So I definitely would encourage younger LPs and allocators out there to do the same. I would love to chat with anybody about Screendoor. So if you are an emerging manager who is interested in sharing your work with us, we would love to hear from you. We have an open website submission. So if you go to our website, screendoor.co, you can share everything with us. It goes right to our team, and we love to learn about what you're building. And if you're an LP who is looking to learn more about Screendoor or collaborate, we would also love to hear from you.
Lisa, thanks so much. It was well worth the wait. And we can't wait to have you back on in a year or so.
Thank you for having me. This was so much fun.